AI is changing the game, but is the risk finally catching up? This is Inside ETFs, and we're talking about AI. For months, investors rode the AI boom, convinced it would transform the economy. But last week, that confidence cracked. After startup Anthropic released new tools, markets jolted, and suddenly the downside risks of AI were on full display. Even after a rebound, volatility could be emerging as the new normal. And as the blast radius of AI disruption grows wider, should your portfolio stay all in? Let's ask Jay Jacobs, US Head of Equity ETFs for BlackRock. Well, Jay, BlackRock's innovation and tech active ETF hit $8 billion in assets in just a year, the biggest AI fund in the US. But last week's tech sell-off did show the risks. Can investors be shielded from these swings?
Well, I think this is exactly why an active approach to artificial intelligence can be so valuable. We've seen so many investors just looking at broad exposure of the tech sector and saying, I have tech sector exposure. That means I have great AI exposure. What last week revealed is that is not necessarily the case. Certain names within the tech sector may absolutely be on the more disrupted side of AI rather than being on the disrupting side of AI. So having an actively managed fund like BAI be able to navigate those nuances, pick potential winners in the AI space can really put investors on the forefront of this theme and not on their back foot.
Let's talk about that selection process. Your top holdings are chip makers like Nvidia and Broadcom. With chip prices surging and performances diverging, how do you pick long-term winners?
Well, overall, this strategy is really looking across the AI value chain to find some of the best opportunities, both individual names across the value chain, as well as shifting exposures into parts of the value chain that make the most sense at this part of the cycle. So right now, if you look at the holdings of BAI, it's actually very tilted towards the digital infrastructure side of the value chain. Chip makers, digital infrastructure, some power names, a lot of the companies that are generating revenue in artificial intelligence today. We expect that over time, as AI starts to get more commercialized, then you see more adoption, its exposure could shift from the digital infrastructure space into some of the more large language model names or even into some of the applications that are adopting artificial intelligence for its products.
Well, as you said, investors are snapping up the AI picks and shovels as hyperscalers pour billions into data centers. But with big spending under pressure, could that cash tap run dry and spell doom for the AI value chain?
We think that this is very well funded because if you look at some of the names that are spending these hundreds of billions of dollars on this infrastructure capex boom, they're some of the largest companies in the world with some of the lowest costs of capital and some of the most profitability. So when you look at how this is being funded, unlike 1999, where you saw a lot of funding purely on speculative businesses, this is being funded by existing businesses that are generating billions of dollars of profitability, and they're reinvesting that cash flow into this infrastructure. So that gives us a lot of confidence that these companies can fund this build out. And there's a reason why the biggest companies have been really leading thus far is because they have the deepest pockets to be able to fund this build out in artificial intelligence.
Well, as enthusiasm levels lower and both retail and algo-driven flows shift, how can investors approach AI ETFs when some think that the theme has been exhausted? For example, are software stocks now to be avoided?
Well, I think you can always look to a fund like BAI to actively navigate the changing shifts within the artificial intelligence space. I would also encourage investors to look at some of the tangential themes around artificial intelligence, which maybe are not so much of a double click to the tech space, but might still benefit from the rise of AI. For example, looking at the power infrastructure space, POWR, these are companies that might benefit from growing power demand in the US, which is very much tied to the AI theme. Or secondly, you could look at something very niche like copper miners or ICOP ETF, as you see copper demand surging when you see more data centers being built, more semiconductors. That is creating a lot of demand within a very narrow part of the metal supply chain.
Well, it seems diversification is key, and you note that income-oriented ETFs are growing in demand. Can they offer protection if the AI bubble bursts, especially when, example, your large cap premium income active ETF's biggest weighting is tech?
Well, we see these funds as a very different type of strategy than artificial intelligence. BAI, it's really trying to capture a growth-oriented theme with AI. Bali, our large cap premium income product, is really looking to increase the yield of portfolios for retirees. Right now, if you look at the landscape of wealth in the United States, about 3/4 of wealth sits with people who are over 55 years of age. So this is a group that maybe is not so much focused on just kind of pure growth. They want to participate in the market upside as well as have higher income from their portfolios. So Bali is really designed to give you both some of that market participation with US large caps, as well as increase the yield of your portfolio.
That was Jay Jacobs from BlackRock. Don't forget, you can watch more videos on Reuters.com.